So, hello everyone. Welcome to the One Lattice podcast. I'm Harsh Salgaonkar, AVP in the BFSI vertical at One Lattice. The topic for today's discussion is the RBI's latest guidelines around FLDG. And to discuss that, we have with us Mr. Nishant Bhaskar, who is the co-founder of Fundfina. Just a brief background on Nishant. He's an alumnus of NIT Trichy and has spent over 2 decades across consulting, investment banking, and venture capital. He co-founded Fundfina back in 2018. In brief, Fundfina is a B2B finance player that empowers corporates to develop custom lending products for merchants on its platform based on their cash flow and financial performance. Nishant, great to have you here and a pleasure to be doing this.
Thanks a lot, Harsh. I think we have been talking about it for quite some time. So glad to be
Yeah.
finally kind of
Yeah.
doing it. And part of those time, of course, has been in midst of the topic we are discussing. So yeah, quite
Yes.
excited to kind of opine on it and see how it goes.
So Nishant, I'll just set the context. The
Sure.
RBI back in June 8th of June this past year announced, a fresh set of guidelines on the bank fintech lending partnership model, which is more popularly known as the FLDG or the First Loss Default Guarantee Program. Uh, Through these guidelines, it is expected that there will be much needed clarity on FLDG partnerships between regulated entities, that is your banks and NBFCs, and the lending service providers, primarily the fintech players. The central bank has provided transparency and regulatory sanctity and has sort of established boundaries which will help the financial services sector and to grow and further drive
Sure.
financial inclusion.
Sure.
The RBI's approval on the implementation of FLDG guidelines, it is seen as a significant development, providing respite to many fintechs who faced, severe challenges in the wake of the digital lending guidelines, which sort of came last year and earlier this year as well. So can you provide an overview as to what the new FLDG scheme is and the kind of clarity it brings into the entire ecosystem?
Yeah, sure. So let me give you a little bit on Fundfina, what we do, and why we are in midst of, I'm like directly impacted with whatever has been going over last 12 months or so. So as you previously said, we are an embedded platform. So we are a B2B2B, a platform which embeds on both sides, demand side and supply side, with uh, all kind of enterprises and institution regulated or non-regulated. So demand side, of course, a lot of non-regulated, but on supply side, a lot of regulated entities, and that boundaries are blurring all the time. So, having said that, our model pretty much was focused a lot on micro and small part of MSMEs.
Mhm.
Um, Traditionally, this segment has been underserved for quite some time. If you look at the statistics of credit gap, just even take India, the 300 billion small business credit gap, a large portion of it, 90 to 95%, is within that underserved micro and small kind of segment. Now, this segment has been perceived as quite non-credit friendly, perceived at very high risk by traditional institutions. And that has meant that whenever they look to lend out to this, they want some kind of back-end guarantee schemes to do so.
Mhm.
And I'm just putting the FLDG in context of why it was first there and why it is even now. Now, how would you provide that guarantee? Guarantee can be provided by government as well, in form of priority sector lending and having some kind of partial guarantees for the portfolio. That could be one way. Or if there are innovative companies, fintech such as us, trying to target that segment, and we, of course, targeted that we will do whatever to improve, grow, manage, and protect the cash flows of these small business. So our primary modi was that, hey, regulated entity, participate in this sector. There is scale, there are money to be made. Uh, about your perceived risk and ability to price this, we can help you on both. Pricing, we will look at a lot of alternate data. And then on the perceived risk, we can enhance some of those perceived risk by posting first loss default guarantee. And that has
Mhm.
traditionally been what FLDG has always been about. That even when it was not regulated, institution to institution posting default guarantees for a portfolio of loan has been as long a norm as you can think of. In capital
Mhm.
market, it happens all the time. At a overall portfolio bank level, it happens all the time. So all RBI guidelines did was, uh, at least in the small ticket sizing section, in the small non-regulated entity and regulated entities working together, it legitimized posting that FLDG before. Previously, FLDG was guarantees was always there. It was it could be as low as uh, 10% going up to 100%. 100% meaning
Mhm.
complete coverage on all the portfolio. Effectively, you are
Mhm.
giving money and using financial institutions as an umbrella entity to do so.
Mhm.
So FLDG one legitimized that okay, this is you can post FLDGs. There are no gray areas. Number one. Second, it set a limit, which is quite interesting. That 5% of the overall portfolio. Now, and this is where interesting comes. That how do you define the outstanding portfolio? We'll come to that in a minute. That will be though at 5%. So still, if your losses in that portfolio is 7%, fintech will take care of 5%, 2% still regulated entities have to take care of.
Mhm.
So
Yeah.
that's one. So they put this number as 5%. And then there are other mechanisms of how you can post. It will be upfront cash or lien or some of those sort. Those kind of things will be there. So it actually legitimized the whole unregulated to regulated posting, and it set a limit, and it set some mechanism on how it will be posted. Where it didn't do too much, and which is depending on each of the regulated entities, is what they define as their portfolio. Um, they could be agreeing in some other arrangements beyond just posting FLDGs. It could be performance based remuneration of the loan service provider or unregulated entities, and those kind of sort will be there, which is we are in midst of that. So though it has been legitimized, a number has been put, a mechanism has been set, there are things around it, be it back book of previously higher FLDGs down
Mhm.
to they effectively what regulated entities are saying is if we have to participate in some of these sectors, we want even further guarantees in some shape or
Mhm.
form for us to do so. Um, which will be, we can discuss more as to what has been positives and negatives in that regard.
Mhm. So overall, these new guidelines, how do you think they sort of help provide an opportunity to fintechs, such as Fundfina?
I think one thing is for sure, legitimizing the whole thing means that many of the people who were on the edges that, hey, should we do it? Should we not do it? That has come about. I mean, like now for slightly scaled up and we are a decent scale up ourselves, we can have genuine conversation with any regulated entities to strike this conversation. Of course, how you operate that is a different thing. Still, in our experience, we have talked to a lot of bigger NBFCs um, and small finance bank. We have yet not talked to commercial banks, not because they would require FLDG. Their problem is the perceived risk profile of this micro and nano segment, um,
Mhm.
which is what I think where we need some harder discussion, or maybe it is a long gestation game that FLDG was incorporated and legitimized to really open up the sector we are talking about. And
Mhm.
the current guidelines, hard guidelines, what it will be, it will have some positive impact, definite positive impacts on this relationship between regulated, non-regulated. It means slightly more monies to small segments of, but the micro and nano part still, I think, requires a different way of ensuring the guarantees, um, be it a better participation from non-regulated and regulated, or government putting in some even more robust uh, priority sector guarantee schemes for this sector.
It's interesting you say that banks are sort of apprehensive or looking at it as a higher risk when it comes to these
Hmm.
micro sort of spaces. But aren't these part of the priority sector lending, which they anyways have to cater to?
It is, and this is where. So remember, our we have always primed and prided ourselves to be a financial inclusion platform. And our
Mhm.
experience is that the most starved segment of micro and nano, which are typically small shops in hinterlands of India or any suburban parts of India, single
Mhm.
shop owner with couple of boys or girls working with him or her, that that part is quite underserved. And though they are priority sector lending, many of the time they don't even make the credit appetite of our scheduled commercial banks. They just don't. Uh,
Mhm.
they might do if they start posting collateral or they do group loans as microfinance does. Then it really becomes slightly more tenable. But many of the actual priority sector lending are out. Yes, people who definitely benefit are small and medium MSMEs. I mean, like if they are part of it, they will definitely fall because they are part of the priority sector lending, and people have to
Mhm.
meet those targets for sure. Um, just to give you some data on this, right? So when we started, one of the reason we got grant and equity, non-equity funding from the likes of IFC, World Bank, United Nations was, hey, you work great in expanding the pie. And just to give you some statistics, out of 10 MSME small business that we had approached over the last 3.5 years when we have worked, um, 6 to 7 don't have meaningful CIBIL scores or bureau reporting.
Okay.
So, and that is pretty much the starting point, even in priority sector lending for many of the scheduled commercial banks. And that is where I
Mhm.
think the whole FLDG regime was to kind of bridge this gap. That if you want to take a punt on that rest of the portfolio, fine, here is a fintech or a non-regulated entity ready to post something for you to participate.
Mhm.
And we have done reasonably well in that, but scale up is a different thing. I mean, like if you really want to make a dent in this 200 billion, 300 billion, you as a combined entity need to do upwards of 500 to 1000 crores a month at the bare minimum. You are, and you even then
Mhm.
you are scratching the surface. And that kind of scaled up supply side commitment, I think it's a long way to go. And even current FLDG from fintech partners, etc., I think is way too short. I think you need some policy level priority sector lending, particularly for micro and nano.
Mhm. No, it's interesting you say that micro and nano sector has always kind of been underserved, and the RBI's I think broader objective has always been to sort of enhance credit availability to the masses. Like whoever
Correct.
cannot get credit, how do we sort of reach them further? And precisely this is where FLDG one sort of targeted. Right, most of the FLDG partnerships were around lending to micro and nano sectors, and
Hmm.
perhaps I believe that's the reason why the RBI, although they banned it initially, right now they have come out with enhanced guidelines because this they realize that there is some merit in this program. So
Sure.
with regards to this, how do you see the guidelines now acting as an enabler? Now the fact that there is much needed clarity towards the relationship between who's an RE, what they can do, or other regulated entity, and who are LSPs and what do they do?
Sure, sure. So let's break this down, right? So I generally think any kind of default guarantees, it operates at various levels of credit life cycle. So one level is actual risk assessment of the people on
Mhm.
behalf of whom their guarantees are being posted. So that is one. So credit assessment is one. Then comes much more capital efficiency, both from regulated entity part, but even if you aggregate it out, even at a macro level, aggregated for all regulated entities, what is the
Mhm.
impact on the credit market itself? So on the risk assessment part, once you have priced them, do posting guarantees enhance their risk profile? 100%. 100%, right?
Mhm.
So if you're posting, the perceived risk appetite slightly becomes better. However, one of the guidelines part which I do like is they say that all the regulated entities, if it falls in NPA, you still have to declare it. You might put
Mhm.
FLDG recouping that you do as recovery is part of the money, but you have to declare those as NPA in your book, and then
Mhm.
see FLDG recovery as whatever as a genuine recovery mechanism. So that is one thing you should be aware. Now, so on the risk assessment piece, it enhances the overall profile of the portfolio at an individual level. It genuinely doesn't do any massive to the risk profiling until unless there is a guarantee being posted on behalf of those retailers by someone else.
Mhm.
And in our case, we are an embedded player. We have anchor partners and we give out loans to their merchant. It could happen that the anchor partner themselves post FLDG, but even in those scenarios, it's a pass-through mechanism from us to the regulated entities or directly from anchor partners to the regulated entities. So at an individual level, credit assessment, I don't think it massively improves. At a portfolio level, credit definitely is perceived as lower less because of you posting FLDG. So that is one part.
Mhm.
The other part is capital efficiency. If you start posting FLDG, which is what in the previous guideline they had said that this is almost like a synthetic securitization,
Mhm.
which is what RBI had said, till they then clarified later in June, July with a new guideline. I think those part is very relevant to the whole capital market side of thing. It is at a portfolio level, you have provided a guarantee. You have slightly credit enhanced the portfolio by the synthetic securitization. It could
Mhm.
pave way at enhanced level to actually sell out the portfolio with these guarantee schemes at a
Mhm.
portfolio level. So I genuinely think that some of these guarantee schemes might enable securitizing the portfolio, which of course is great because then you have even bigger chunk of capital that can be posted.
Mhm.
Um, in the unsecured credit world, I still think that the securitization in a is it has to go. I haven't seen many successful transactions yet in this space.
Mhm.
But because of the FLDG guideline setting, this could pave way both in terms of how regulatory positioning it is, how acceptable it is, and then how would it treat as credit enhancement or synthetic enhancement of the securitized portfolio. So that will
Yeah.
happen. Um, Participating in sectors, absolutely. The small will benefit. Micro and nano, actually, they could be slightly impaired in lower terms because of these whole legitimizing. There is definitely a
Mhm.
cherry picking happening from regulated entities. They say
Mhm.
that on one hand, I one thing of course I like is they are now much more design driven approach, more time in due diligence of that portfolio, curating that portfolio. So the whole
Mhm.
risk profiling, etc., has massively increased from regulated entities, which is a welcome change. Finally, previously with higher FLDG, they wouldn't even bother to look at the portfolio. We are covered. Let's not do. But with
Correct.
5%, they have to be extra sure. So better risk management practices, which absolutely what RBI aimed, and I think it will achieve there. On the other side, what I was mentioning that some of the micro and nano, at least in short term, people will pull back and give loans to the people who are much more in the mainstream with a meaningful credit bureau reports, or they can submit their bank account statement, etc., much more better. So that impact, I think, in short term, it will actually reduce the appetite in that sector, and people will be much more choosy to pick up the
Mhm.
best, which I think it is fine, but you have to get the other people in the net. And the only way to do it is some kind of form and guarantees through other mechanisms.
Mhm. There's actually going to be my, follow-on question,
Sure.
since you mentioned about certain sectors, which would sort of be affected,
Mm,
because right now, I mean, just before sort of the guidelines came in place, I believe unsecured personal loans and business loans, those were the two sectors where I believe the FLDG limit was above 5%, as in what LSPs were providing to regulated entities. Now
mm,
that the RBI has capped it at around 5%,
mm.
what impact do you see these two specific segments have?
Yeah, so absolutely. I was going to define sector not in traditional terms of it, whether it is a grocery store or a stationery or a payment service provider or pharmacist, etc. I would take a view of transactions. How much transactions do they do month on month? And I
Mhm.
definitely think that people who are doing more transaction with greater frequency, at least in high turnover business, which Kirana Tech, Pharma Tech, all of these pharmacists,
Mhm.
etc., are, for them, those retailers who are doing higher transaction with higher frequency, they will be favored more. There will be more
Mhm.
allocations going on to them, which means that some of the other sectors which are slightly lower transaction, lower frequency, they might be impacted in short term for sure.
Mhm.
Um, so that will be one of the recurring kind of themes. There might be tighter allocations in some of the other sectors. For example, historically, many of the payment service provider retailers NPAs have been found to be quite big. So
Mhm.
if it is going beyond that 5% coverage, you definitely would have a tighter allocation. So I definitely think that some of the payment service providers, some of those sectors, though their retailer footprint is huge,
Mhm.
they will face tighter percentage allocations to them because their NPAs overall are going beyond that 5 to 10% mark.
Mhm.
So
So
that's
Nishant,
happening. Yeah.
most of our discussion around the guidelines has been, what the impact has been on fintechs or on the regulated entities or banks and all. But if I have to take a view of the consumer lens over here, right,
Mm,
someone who's actually benefiting from the FLDG guidelines, someone who's actually getting the loan, right? It could be the Kirana store owner, like you said, or it
mm,
could be a regular customer who's availing a personal loan.
mm.
So what changes for them? How does life become better for them, or does it become worse?
See, there those people who have meaningful credit scores, but still were not able to, or meaningful credit score even at a lower level,
Mhm.
200, 300 level, they will definitely benefit. I think
Mhm.
because of the portfolio, someone posting almost like a collateral on their behalf,
Mhm.
they will see that both they have more access to capital, and second, even when the access of capital is there, they will get slightly larger lines as well,
Mhm.
which was a constant grouse for us as well. Many of the small chotu guys, they will always say that what you are giving us doesn't quite cater to what how much business we do. Of
Mhm.
course, that has slightly different issues that you, at least when you start taking on alternate data, then digital footprint is what you normally are able to access. Any kind of offline thing, you will have to take a leap of faith that, okay, he's doing offline, his 50% of the business is offline. So we will extend this credit by 50% or whatever. So
Mhm.
I think so. It will benefit definitely who have some kind of meaningful credit imprint or whose alternate data make the cut, both for them qualifying and them getting higher kind of ticket size. But even in those people who are really at the low end, who don't have the meaningful score, or even their alternate data is lower, and their traditional thing is beyond 5% NPAs or write-off, then they will face more lesser credit being available to them. Overall volume perspective, I think it will make up in short term, that because of these people having more and these people being cut, it will net off to a certain extent. But at some point of time, I expect that slightly lower chunk of the guys, because that is how fintech will, if they are lower served, they will have to find a way to kind of serve, which is true for us as well. Out of 10, okay, 3 or 4 people are definitely benefiting. We are extending our ticket sizes as well, etc. for them. But beyond that, our posting 5% FLDG um, would need more regulated entities, people who have more lines committed coming onto the
Mhm.
platform. What convinces them? Would 5% FLDG convince them? Probably not. You would have to engage in some kind of performance oriented lending as a service scheme, or become just a SaaS platform, etc., which
Mhm.
anyway um, you would be, from unit economics perspective, not willing to take balance sheet risk. If your business model
Mhm.
says that you shouldn't take balance sheet risk, then you wouldn't, and which has its own difficulty in this sector.
Yeah. And how has Fundfina sort of, managed this whole new guidelines thing and all? I mean, you were earlier giving FLDGs as well, now with the 5% cap. So if you could, sort of give us some insights on that. What
Sure.
percentage cover were you providing earlier, and now with the 5% cap coming in?
Sure. So we always we were very clear. I come from a lot of banking background myself, and I was
Yeah.
very clear that it doesn't matter whether you're posting FLDG or whatever. You are taking a balance sheet risk. You are acting like a traditional lender. Yes, you have a great platform and data story, and you are reaching out to the segments that those regulated entities don't. But you are taking a balance sheet risk. So in and we had started the company much more on the platform approach, but
Mhm.
kind of figured out that in this marketplace, at least to certain level, you have to make the market, and the only way to make the market is by posting FLDGs. So
Uh-huh.
we were pretty much said that okay, that's practical, we'll do that. But at the same time, platform business was also there. So we always were biased towards a lower FLDG model. I'm like, even when we started, we never entertained any thing more than 15-20%, even from day one. We walked away
Okay.
from at least 3 to 4 deals which had 50% FLDG, 30% FLDGs. And those were difficult even that time, that we didn't have anything to prove and we were walking away from the deal. But we were very clear that this is not a tenable proposition. Um, I'm like posting 15-20% FLDGs or even 10% FLDGs in a scaled up scenario is not a tenable proposition. So
Mhm.
we constantly worked out a way that for some of the NBFCs, even at the expense of our income margins, we said that we wouldn't post. And if you're happy to use us for end-to-end kind of uh, originating, pricing, and servicing, and you want to pay us on basis of those performances, we are happy to do so without posting FLDGs. So clearly, we had two different models coming in. One very platform driven. Here is the X percentage of your platform gross transaction value, 2 to 3% or whatever that is. We only get that. And then there came the FLDG scenarios of making market, and we actually became very practical that listen, because of FLDG, you are letting us test out our alternate data scoring mechanism, which we call true score. So fine, let us do that, but we will do end to end. You don't apply your credit characteristics on the top. You will
Mhm.
just transact through that. So almost like two different models, one platform model, one FLDG led model. And now as we are even scaling further, some of the scheduled commercial banks they are saying that we are okay for you to operate as a platform, but we want our modeling and mechanism to be applied on the top. So now we are in that phase of increasingly making more and more defined um, lending parameters for each of those lenders, and make those as a business rule for even qualifying out any loans. So so that's almost like a third model, which is a hybrid between two, which is evolving mostly as a way to get pakka supply side bigger lenders.
Okay. With the now that there is a cap on how much FLTG cover can be provided, and the fact that a regulated entity now has to recognize the NPA on its books. Have you
Hmm.
seen some kind of, if I may put it, a discouragement, amongst the acquiring lenders from entering into partnerships with fintech into higher yielding segments, and hence there is a general preference for them to prefer non or rather less risky assets.
I think bigger lenders, more systematically important lenders, so say
Mhm.
500 crore AUM and above kind of lenders, they definitely what you said about um, slightly mid-yielding asset, which are traditionally under 5%, they definitely are preferring that. Smaller
Mhm.
NBFCs that are 50 crores to 500 crores, they they can take punt on both. I still see that some of them are saying, yeah, your high yield credit line kind of product, which provides month on month dispersal assurity at a higher yield, we will entertain that and we will do that. Yes, 5% FLDG, we will comply to that. But some of them also find a way of doing some performance based paybacks on that as well. So smaller NBFC, etc., they definitely continue to participate as they had. And if your performance is good of managed NPAs of 2 to 4%, you they continue to increase that lines, etc., because literally it is 100% coverage on the portfolio.
Mhm.
So that is happening as well. But general bigger players on high yielding segment, even with FLDG, that's quite difficult until unless within that sector, within that regulated entity, they have big plans to do, I don't know, experiment on embedded finance, or
Mhm.
they have suddenly got someone from impact sector from outside, typical international development, big impact investors from Europe and US giving a line. Many of the Omidyars or the Bill and Melinda Gates Foundations kind of people providing that debt line, then yes, people can participate in those kind of segments. Yeah.
So, while most of the regulated entities have sort of stopped taking FLTGs on new loans, specifically those that have originated from non-regulated fintechs, I think the proposal to announce a regulatory framework will sort of help bring in more clarity, as digital lending is here to stay,
Yeah.
and increase substantially in scale. So, in this regards, how is the new scheme sort of positioned to provide further impetus to digital lending in India?
I think it will overall see, I alluded to it. One, suddenly the scrutiny of the portfolio construction, risk assessment, how you monitor report on those portfolio, it's a great step because it will, which I always found the diligence, even from the best of the regulated entities on this, quite uh, um, wanting. I'm like, there were way too many gaps. And we were doing our partnerships from 2019, 2020 to 22. I mean, like people were getting into partnership, but nobody was spending enough time to say that this is what portfolio returns look like. This is how are you going to calculate in uh, when particularly NPAs happen, when NPAs happen and you are recovering. Those kind of details were never discussed. I definitely see that there is a much more diligence on that aspect. So overall, credit risk perspective, design portfolio monitoring, very good. What it also gives is a particular framework for biggest regulated entities to participate with the best performing portfolio as well. So that in the long scheme of things will happen. I think in interim that difficulty that micro nano will have a slightly lower participation that we gonna experience um, even on the smaller unsecured personal loans, similar kind of thing that will, which means that you will have other high yielding payday kind of lenders
Uh-huh.
who will come in and who, because of the regulatory frameworks, will fill in some of those gaps,
Mhm.
um, and they will operate in a matter of 5% posting of LDG and rest on some kind of performance scheme or completely originate scheme. So it will have both. Long term impact, absolutely no doubt that I am not sure about this 5% bet, frankly,
Mhm.
but this will um, kind of increase the participation overall, first at the best perceived one, and then it will trickle down to the other segments.
Understood. And from a venture capital angle, I'm sure you must be speaking or in touch with a
Yeah.
lot of VCs. How do they, how are they looking at this development? Are they positive on this sentiment? And in general, investments in digital lending overall, do you see them picking up?
So it has been impact, right? So this is probably the most difficult last 15 months in
Mhm.
digital lending funding space for sure. Ever
Mhm.
since we were in that boom cycle from 2016-17 to
Mhm.
now in the lending tech, credit tech, that has decreased. However, it's not a very black and white story. I think you will see that more and more regulated entity and people who have got some scale, they are getting even bigger funding round. So
Mhm.
that is also happening, uh, and which kind gives you clue that traditional regulated NBFCs who are interested in becoming or acquiring or are developing digital or alternate data angle, they will be back in vogue. I mean, like they will also attract VC funding, which was almost very rarely before. So we will see that even family-owned tech, which has been operating for 20 years, and they in last year they have tied up with various fintechs and they have been remodeling themselves as the new age NBFC. They will attract investment, no doubt.
Mhm.
Um, Regulated entities will attract slightly more funding, at least in credit facilitation space. um, they will also get slightly better valuation, which is not just 1 or 2x of the book value, which they had traditionally got. So they will get that. For typical fintech who are not regulated entities, for them, I think that clarity of are you platform only or you would at some point of time become a regulated entity, or
Mhm.
you have a strategic partner which is a regulated entity. Those
Mhm.
will be more favored. A typical fintech with no regulated entity, no aspirations to become one, they have to quickly decide that would they operate to only be a tech provider or a SaaS provider, and then get that hoping to get that 20 to 25x on their on. So that is one. If they are LSP, pure LSP that they are facilitating for others, then you could definitely say that they will be at the lower end between that 5 to 10x, 5x of a regulated entity valuation kind of game, and 20 to 25x of this SaaS or tech provider. So they will be
Mhm.
somewhere, and even there they would have to be very clear that when are they going to become one, or would they operate just as a LSP? How are they going to survive in a scaled up scenario?
Yeah. So as we sort of draw to a close to this discussion, I think one
Yeah,
thing that we can summarize from whatever we have discussed till now, that
yeah,
the arrangement will sort of help open up the market for early stage fintechs who are sort of looking to partner with banks and with NBFCs, or rather, I would say regulated entities, to gain some kind of exposure to the credit sector without having to wait for an NBFC license. While low FLDG is certainly good for fintechs, that have sort of struggled with capital that gets locked in. Uh, do you think that smaller fintechs might find it difficult to obtain hard guarantees, like cash and FD, as has been mandated, in the new guidelines?
yeah. And this is where I think because of these smaller fintechs that are just starting, many of them would have to be great at originating, or yeah, originating primarily. They start off their journey as a distribution. I'm like someone like us who started our journey as more who could do pricing very well of a credit product,
Mhm.
and then through that we started building our originating engine. I think for someone who is just doing pricing um, and not ready to spend enough time or money to make the market, it will be difficult for them now.
Mhm.
However, having said that, some of the slightly scaled up people, if they have to break into a newer sector, they actually will find it easy as well, because with some minimal posting of the FLDG, they could do some sensible pilot, and they can say that okay, this sector is good, and that sector could be anyone. It could be a new geography, it could be a subset of sectors. For example, even in our case, I'm like um, we got many distributors whom we couldn't cater for because their
Mhm.
ticket sizes were quite high. But we learned that overall their NPAs are much more smaller to the micro and nano retailers. Then in those kind of sectors, we could easily post minimal FLDG and get some really big lenders to start the pilot.
Mhm.
But that is only for us who have operated for almost like 3.5, 4 years and
Mhm.
got some kind of scale. If we were just starting out and doing this, I don't know how would we convince a traditional lenders to come and participate until unless
Mhm.
we say, here is the platform, do whatever you have to do. In which case, you can't hope to get anything more than 1% of any kind of origin. Even 1% is quite high.
Yeah, that's good. So that brings us, to the end of today's session. Any closing thoughts you have, Nishant?
Yeah, I'm like, see, I view default guarantee as an overall positive in any regard, particularly if you want to enhance participation in a underserved segment.
Mhm.
And so that is great. I also recognize that what RBI typically wanted to do was not only legitimize, but enhance the credit practices of many of the regulated entities. So, as a general theme, getting regulated entities be responsible for more is a great thing. I do think that policy needs to go step further in being prescriptive on how much portfolio should it go to micro and nano segments. So micro part of MSMEs or people who are most struggling even on the unsecured side, who are living from pay to pay. I think those two as a guidance, be it very strict guidance on guidelines or actually providing a guarantee scheme that you could
Mhm.
avail jointly between fintech and regulated entities as a joint, that will help a long way in even further improving this sector. And it's a recursive cycle. More number of people you bring in the net, I think they will further improve. And our suggestions. I can give you some quotes, right? So when a World Bank did a big survey on more than 5,000 of our customers, and it's a great. One of their results was um, 8 out of 10 of our segments. They said that they didn't have any access to alternate funding apart from Fundfina. Now, it's a great
Mhm.
checkbox for us. We absolutely pride, but I find it pretty disheartening as well that there isn't enough players who can give them, and they are saying that 8 out of 10. So I just house think that this needs even more concentrated effort, and FLDG is a great direction, particularly from our regulated entity. Improve how you give out loans in this sector and legitimizing it. But I would see even further step being taken, prescriptive or non-prescriptive steps being taken to even further enhance credit in this supply in this subsegment.
Yeah. Yeah. So I think that was all, from us. So thanks a lot, Nishant, for taking
Sure.
out the time and for sharing your views. Really enjoyed this session. So I hope that,
Thanks a lot.
we can do many more such sessions again.
No, thanks a lot, Harsh and entire team at One Lattice. So they have yeah, really persisted with it, and I've been, just to be very transparent, I've been great fan of what you're writing and with quality with which you are doing research focused on fintech. I think it is one of the best, at least in Indian context, I have seen. So continue that work, and I will be great to kind of participate in some of those research activity as well soon.
Thanks a lot. Thanks for your kind
Thank
words.
you.